Hello everyone, we're going to present the facts today and what is currently going on in the market. As you know, I'm currently holding on to puts that expire 8, 12, 16 weeks out. But currently, we're going to take a look objectively of what is yet to come in the market. We're going to take a look at the SP 500, NASDAQ, the Russell, the large tech stocks as a whole, the VIX, and we're going to put everything together, look at some information, incorporate how Apple earnings this week is also going to affect the overall market, and take it from there. All right, so without further ado, let's get started with the video. So, number one, Apple has earnings on Thursday. We know that earnings causes a spike in price heading into the earnings date, which is called the earnings run-up. So, that is a big portion of what we saw this week. So, heading into the earnings date, generally, you see price continue to rise, which is what ended up happening with the other large tech stocks that had earnings this past week. So if Apple continues, upwards in this trajectory, it should cause the market in general to do a bit well heading into the end of the month, right? So, these next few days should technically be bullish for Apple, okay? Google, we hit our upward target on Google. We had earnings on Google, right? And it continued to spike up into earnings, and price continued to do well. We had a perfect touch of this 198 level on Google. I was bullish on Google down here at 175, 176 area as we were breaking out of this downtrend. Now Google is at a major level of resistance. Literally, the upside target has been met. This is not, once again, on Google. This is not the time to start going long, in my opinion, on Google. Amazon also. Amazon broke above and touched perfectly on our very major target to the upside. Amazon also has earnings this week. So with these large tech stocks as a whole had earnings last week and this week, price tends to do well into these times, right? So we're holding the 230 level. We were bullish on Amazon down here at 215, 214. And now things are starting to break above 230. If they remain above 228, 230 area, this can be a good, tight, long opportunity where bullish momentum can continue. We're also in an uptrend. All of this coincides with support being held at this 228 level. If 228 can hold, then yes, the market can continue rising and Amazon can hold. Amazon looks way more bullish than Google did. It's a way better setup, in my opinion, to be long on Amazon than it is to be long on Google. When you're looking at Tesla, Tesla has been in a there's a lot of tough stuff going on with Tesla at the moment. And what you want to see with Tesla is essentially this 323 level needs to break. So as you can see, this 323 level has been a very, very major level of resistance and support. Clearly, right? And we wicked right at that 323 level on Friday. We had a high at 323.50. So we need to break above and hold above the 323. Have your eyes on that 323 level on Tesla. If we could break above, Tesla looks very, very bullish. And that is a very, very major point that needs to break to the upside, okay? Now, Netflix is holding this major level of support. I was mentioning how it would fall down to these prior levels of support. And that is exactly what ended up happening. We came down to 1150, right? I was saying 1150, 1160 would be a major, major level of resistance, support. And literally, we came to a low of 1162 on Thursday, and it held. So this is clearly not the time where you want to start being aggressively short. Does that make sense? So after a large move already occurs to the downside, right? Support's broken. We're coming down to a major level of support. This is not the time where you want to start being aggressively short. The same concept is when you continue to make new highs, that is not the time where you want to be aggressively long, right? So you just have to look at where we're currently at on the chart and make the best decision from there. Okay, so this is currently what's going on, in my opinion, on Netflix. It should stagnate a bit or give a bit of a bounce off of these levels. Definitely don't want to be short, and trying to force a continued move to the downside is not intelligent, in my opinion. So now NVIDIA and AMD are both showing very interesting signs here. NVIDIA is retesting, and it made a bit of a new high on Friday. But this is not just an automatic reason to be extremely bullish or bearish. We played to the downside earlier in the week. This is still leaning bearish. This is not the most aggressive, best long opportunity. So in my opinion, yes, we should probably see 176, 177. The reason for that is because AMD still has room to go to the upside. Now, AMD has been a big driving force in the overall market here on NVIDIA and on the chips. So if AMD is going to continue rising here, and we still have more room, a couple dollars to the upside on AMD for us to get to this 2.618 fib extension, AMD is going to rise. Most likely what's going to end up happening is NVIDIA is also going to rise. So with that being said, you have to be very, very vigilant, and you have to take into consideration how these stocks move together in unison. This is currently what's going on. So essentially, this was the setup on NVIDIA, right? NVIDIA just made a small little candle here. It just creeped above recent highs. So whereas NVIDIA is lagging a bit here, AMD has already broken out, and it's showing leading strength. It's leading this move to the upside. So we need to see if AMD can continue doing this. And if AMD shoots up another $5, that'll cause some more strength in NVIDIA as well. That's what I'm banking on. Now, when you're looking at the overall market as a whole, when we're looking at the SP500 specifically here, right? We are touching, we're about to be touching the second portion of this rising wedge. So obviously, things are very, very bullish. We're getting a lot of money flowing into the Russell 2000, into the IWM, and things are not being as bullish in tech. So because the Russell 2000 is showing a lot of strength, it's helping prop up the S&P 500. So now we are getting very close to this trend line here, the rising wedge trend line here. And essentially, it is from when you connect the March 25th high to the July 3rd high. And this is the trend line that we're getting. So as you can see, on the 23rd, we got a very, very solid close and hold above the first trend line. This was a very, very major trend line that we've been monitoring from October in 2023. So as we continued rising, you could see that this acted as major support multiple times. And then we got a clear breakdown in March. This same trend line finally got closed above. So we're finally back above this trend line. But now we're getting to another major level of resistance that has still not broken above. Now, obviously, when this happens in the short term, this is very, very bullish. We got two solid closes above a major, major level of resistance. Very, very bullish. So in the short term, like I've said, essentially heading into the end of July, into early August, that's the main reason why I got into very longer term puts. I showed you multiple times we could end up seeing 6,500, but overall this would drop. And that's still what I'm continuing to bank on, in my opinion. We're still day trading. We're still playing a lot of good setups to the long side. We're playing a lot of stocks to the long side as well. These Chinese stocks are doing very, very well, and they're very bullish as well. So Uber, a lot of these swing stocks that we're playing have been doing very well. But in general, in my opinion, I could be wrong, but the setup for the downside is really starting to permeate. Tech stocks are not showing as much strength as the Russell 2000 counterparts. And when the Russell 2000 is the main leader, that doesn't always usually sustain itself. So what you want to see is the NASDAQ show a lot of strength. And what we're seeing on the NASDAQ is, so again, we could have seen the 23,500 level. I was mentioning how 23,500, even 23,750 is on the table. But these are not sustainable long opportunities. We are in a very, very sharp, tight uptrend. And these don't always sustain themselves. They did over here. We held these lows and continued. But for us to continue like this, when the large tech stocks as a whole are getting to major levels of resistance, in my opinion, is not the best opportunity to take strong, longer-term setups. If you do want to go long, you need to have tight stop losses and make sure that this is not a make or break point for your portfolio. Generally, when you guys watch my videos and everything like this, I'm generally always correct about my market sentiment and what ends up happening in terms of direction, right? Timing has always also been correct. But the reason why I gave you guys the apprehension of getting longer term contracts was for this reason, because we are clearly getting a lot of abnormal strength in the market. And I did not want to completely be in the way of a moving freight train. So like I said, when you're trying to stand in the way of a freight train that's moving towards you, you will get essentially run over. You are going to end up getting smashed by the freight train. So you don't want to get in the way too aggressively. You want to get in once the freight train starts to lose steam. That's when you want to grab onto the freight train. And then if you're Spider-Man, right, that's essentially what we're trying to do. We're trying to catch a pullback. You want to pull and you want to catch a move to the downside when the freight train is not as aggressive to the upside, right? So that's why we're getting into longer term shorts that are not as important in terms of our week to week sort of price action. We're getting contracts with extra time involved. Does that make sense? So that's essentially what I'm planning on doing and what I think is the best situation here, in my opinion. In the short term, a lot of these stocks do look good. A lot of these setups do continue to look decent, right? But you have to play the long side with a very, very tight stop loss, because these sort of situations not continue this aggressively. In the long run, months out, I'm very bullish. I was very, very clear and adamant to tell you every dip is a buying opportunity. But that doesn't mean that we're not going to see a dip. Very, very adamant to tell you guys that every single dip that we're going to have in the next couple months, all of these are buying opportunity. But in this short term, in my opinion, there is going to end up being a dip after the end of the month, maybe into the first week of August. I could be wrong, but that's why we got into the puts longer term. You could see 60-50 on the ES. You could easily see 60-50 on the ES. This level can be breached. At that point, we're going to have to, this is not the time to start being long. If we get a break above this trend line, regardless, it's just not the time to be long. And the reason why we're holding on to the puts for that long is the market can be irrational much longer than we can be solvent. The market can be irrational much longer than we can be solvent. So we want to remain solvent in the market. We don't want to put ourselves in a situation where the market, where we get into puts that expire next week. We're like, oh, wow, I need to be correct about this move. Not how you trade. Give yourself space to be incorrect. Unless you're day trading and you have tight stop losses, give yourself space to be incorrect. Give yourself a nice stop loss. You give yourself time, especially if you're trading with options. All right. So that is currently what my thought process is. I hope this made sense. If you guys enjoyed the video, please make sure to like, comment, subscribe. do all that good stuff. I will see you guys bright and early tomorrow. Thank you. Take care.